Good afternoon, ladies and gentlemen, and welcome to the CQS New City High Yield Fund Limited full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, as usual, we would just like to submit the following poll. And if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Caroline Hitch. Caroline, good afternoon.
Thank you very much, Jake, and thanks to everyone who's joining us for this update today. As Jake says, my name is Caroline Hitch, and it's my privilege to be the chair of the board of independent directors of the company. So a few brief comments from me, and then I'll hand over to Ian Francis, our portfolio manager, who will talk about the underlying investments held by the company. So at the back end of last week, we released our annual report and accounts for the company's financial year ended 30th of June 2025. The full report is up on the website, but a few highlights from me. The net asset value total return grew by 6.98%, which sounds pretty much like 7% to me in round numbers. And the share price was about 0.5% higher than that at 7.43%. You may remember that the previous year was exceptionally good for us, with a share price total return of very nearly 23%. And even though we didn't quite hit such heights this year, I believe these results are reasonably good because the bond markets globally were quite weak over this period, particularly longer dated maturities. And New City High Yield nevertheless produced this positive result. This is because the portfolio of bonds held by the company is relatively short dated. The duration at the moment is a little over 3 years, and hence its sensitivity to market yield gyrations is quite low. And I think this is very valuable for investors looking for diversification. One of the main risks that is carried in the portfolio in order to produce attractive returns is, of course, credit risk. We need our bond issuers to pay interest and redemptions when they fall due. And this is where I believe we have a big advantage because the investment management house, Manulife CQS, has good bench strength with their credit analysts, and they support our investment manager. And this allows him to put together a portfolio of bonds where he believes we are being paid adequately, if not generously, for the credit risk taken. Now, just to give you an update on performance since the year end, the total return, share price total return since the year end to last night is 3.9%, and our rolling 12 months numbers are 9.25%. So turning to the all-important dividends, we paid 4 dividends as usual last year and marginally increased the total to 4.51 pence per share, which was nudged up from the previous year of 4.5 to keep our unbroken record of increasing dividends. That dividend was equated to a yield of 8.77% as at the year end. So this is obviously an attractive number, comfortably ahead of inflation and, of course, any interest you could earn in the bank. Revenue earnings per share were 4.3 pence, so we used a small amount of our healthy reserves to make up the difference. And this highlights one of the strengths of the closed-ended fund structure, where this is possible, and thereby we can smooth the dividend payments. Finally, we are one of the few investment trusts on the London Stock Exchange issuing shares because we continued to experience strong demand. During the last financial year, we issued over £33 million worth of shares, which is more than 10% of the value of the portfolio. But we are very careful about issuing shares and only do so when our investment manager, Ian Francis, who you're just about to hear from, is comfortable that he can invest the new monies to the benefit of all stakeholders, particularly existing shareholders. So we have continued to issue since the year end, again demonstrating demand for the company, and basically slow and steady is the trend. So thank you for listening to me. Now I hand over to Ian Francis to give you an update on the investments held by the company, and we'll address the questions after his talk. Thank you.
Right. Well, thank you very much indeed for the introduction, Caroline. It's a very clear one for investors to understand. I'll just, before I really start, I'll address, when we issue shares, why we issue it at such a high premium. I think it's very important for investors to know this because, we're all shareholders on this side of the fence as well. We aim to get around 5+% premium because the fund is managed and priced off bid prices in the market. So you have the spread to deal with. You have a fee to the broker, and you wish to end up giving a bit of capital enhancement to existing shareholders. So that hopefully made that clear. Right, as regards the management of Manulife CQS Asset Management, we are basically the alternative credit arm of Manulife. We look at all sectors of the credits markets, and that's pretty much covered on this screen, which if you wish to read it, that's fine, but obviously it's relevant to the fund in the fact that that's who we report to, but we will move on from there. The fund aims, well, obviously we're Jersey domiciled, therefore investors, when they purchase shares, do not have to pay stamp duty, which is very useful. We are here to provide a high gross dividend and the potential for capital growth. Obviously, the last year was not as good as the previous year, but overall, the returns are very good on a total return basis, and particularly useful for people in wrappers such as SIPs and ISAs, where you can reinvest, and compound interest is a wonderful thing from that point of view. We invest mainly in high yielding fixed interest. We are allowed to go as high as 20% in equities. We like to go into equities with a bond-like sort of feeling to them. Things like M&G, Phoenix, very, very large, very well managed companies, with a very good yield. So, for example, M&G is currently yielding just about 9%, which is very useful for our portfolio, and it gives us some exposure to the equity market, which has been particularly good in recent years. On the next slide, I mean these are basically have already been covered by Caroline, but as I say, why I sort of prefixed the presentation was really, in the financial year we raised £33.5 million, for the fund, which is not only good for the capital of the fund, but obviously liquidity for investors, because obviously the larger you get, the easier it is for investors to buy and sell, and hopefully it allows the market to make tighter spreads in our stocks, which is again beneficial to investors. Obviously, Caroline also mentioned the dividend there. You can see, since I took this fund over in 2007, in the early years we had some very, very high yielding opportunities due to the GFC, and over those years up to sort of 2015, we were adding substantial amounts of cash into the income account, and obviously income reserve account, which has enabled us to have a continually good yield when other people cut dividends in the past, and we still have an awful lot of income reserves there. So, for those of us of my demographic and older, we like our income, and it is good to know that it is safe, going forward. Most important, I mean, markets can, be volatile, so the NAV will, go up and down with markets, but the dividend there is, what we are anchored on. This chart gives you again, a great feel on what compound interest does, for investors. Again, this is over my time running the fund. The return is above its main rival, and we always put in the all share index just to give you an idea of the total return on equity markets. The all share index is obviously far less risky an investment than if you're in high yielding equities or whatever else you wish to issue in the equity market. But it just gives you a sort of a background onto how it works. The investment process, very important. Obviously, I am monitoring everything on a daily basis, from my Bloomberg screens, various vast amounts of emails coming in from brokers with research coming from our in-house analysts, of which in-house analysts and fund managers that are relevant to this portfolio that give me input. There's about 20 plus of us. What we have to do is, for this fund, is look for a yield in a bond excess of 8% on a running yield basis, and we also look at the redemption yield on the basis that I do not wish to have a high running yield with a low redemption yield, because that is going to be converting capital into income. This is not an annuity fund. When we are discussing what goes in and comes out of the portfolio, we look at the ability, obviously, to repay at the end of the term, and obviously, you keep paying the coupons, whilst it's there. We try not to turn the fund over on a regular basis. It's not a trading fund. When we buy it with the idea of holding it to redemption, and reasons that it will disappear before then. It can get called by the company. The company gets taken over, or if we've bought something because we believe it's undervalued, it could get revalued and end up not hitting our yield requirements. That those reasons be sold. And the obvious one is that if a company is not performing as expected, and there's a danger that it can't either pay the coupons or refinance, that is a definite sell recommendation. But literally, we try and get as much diversification in the portfolio as is possible, but there will be some sectors where yields are just not within the target zone for this fund. So that's the process. It is pretty structured. It has to be, because otherwise, it's the fail to plan is effectively planning to fail. Now, this gives you where we are now as regards the sectors. You will see that the financials is our largest sector still. The majority of this is UK banks, basically because post the GFC, rules, regulations, and prudent management means that they're a very, very good investment, and have been for many years now. We haven't got as much in energy. This is due to one or two bonds that we had in the sector being called, and no other sensible, in our view, opportunities arising. Industrials, again, this has shrunk, again because bonds being called away from us, and again no opportunities to replace without increasing risk. Now, obviously, consumer discretionary has increased. We have done that by adding to our Stonegate position, which obviously in the pub sector, and we like people like Stonegate because they're exceedingly well financed, very well managed. They are selling pubs for either to people that actually want to buy it to run it themselves, or mostly for changing into residential area, knock down the pub, rebuild 2 or 3 houses on the plot, which I'm sure quite a few people will see of these. So they are working very hard to make sure that they are a good risk. Consumer staples, we also increased. A lot of this will be things like food manufacturing, where we have an exposure. That's literally doing very well. They are passing on all of the price increases they are seeing onto us poor consumers, hence the higher level of inflation. But unfortunately, it's one of those things we have to put up with. But at least these companies are not being put up against the wall by the sort of supermarkets, quite as badly as some of the poor farmers seem to be at the moment. Real estate, no real change, and materials, yes, pretty much non-existent now. And again, information technology, communication, we've had a couple of bonds called, and again, unable to replace with anything sensible. Yes, I mean, obviously, this gives you the breakdown. We're currently 87% in fixed income, and 12.74%. We don't currently have any convertibles, unfortunately. Mainly because a lot of the convertibles are coming with way too low yields for us. In fact, many of them are actually yielding less than the underlying equities. So the risk reward there isn't good for us. Obviously, risks to the fore. The top two, geopolitics and US tariffs, we all see on a daily basis. Whether it be a Trump rant or sort of what is occurring in Gaza, the Ukraine, Somalia. There are a lot of risks out there. So that's the geopolitics, a very, very large area to sort of cover. But again, because we have so many fund managers here, we have the ability to discuss between ourselves, both the view from our US office and the UK on how we feel it is affecting markets. Obviously, we've been saying interest rates higher for longer, and higher inflation for some time. I mean, the recent press on inflation seemed to be sort of surprised it's at higher levels, but this is something we have been expecting. I personally don't think it's going to start falling much before December, as people sort of discount to sort of try and get sales up for Christmas. But we will wait and see. And to be fair, the Bank of England is doing a good job holding rates where it is at the moment, because we need to kill that inflation. We're not seeing an awful lot of growth in the market, obviously the economy, where stagflation is definitely a danger. We have been again mentioning this for some time. On the currencies, this is always an interesting point. We currently are about 18% in the US dollar, which in the last few months hasn't particularly helped our performance. But against that, our exposure of about 11% to the euro has been much more positive. At the moment, where the UK market is reading the economy, US dollar at 135 to the sterling looks to be too high. My personal view is that we could be somewhere near a 125 would be fair value, given the state we're in. And obviously a lot is going to happen in the period around the 26th of November when the budget comes. Obviously sectors, we have got some very, very good research teams here. Obviously, we have the New City commodity team, which I've worked with for many years, that are absolutely top performers, and do a great job supporting on that area. We also have a very, very good banks and financials analyst who is ex-Deutsche Bank and West LB, a guy called Christian Lucas, very, very talented and very, very good at calling companies which are underrated and also overrated, which is very important to us. Right, this is the top 10 as at the end of June. You see here financials in Shawbrook yielding 11.3% currently. Very, very happy with that. Travelodge yielding 10, Royal London yielding 8.6. You probably don't recognise the name of Galaxy Bidco, but you might recognise Domestic and General, who cover a lot of companies for the insurance of their white goods. Once you've bought it. Stonegate I've mentioned. Aggregated Micro Power is basically a decarbonisation business by form of storage, more efficient heat assets rather than using gas, or that it uses biomass, and they also I think they save their companies that they work for around about 60,000 tons of carbon credits each year. So that's a pretty big green tick. Bellis Acquisitions, ASDA. So that's fairly simple what it does. REA Finance has actually been repaid since the end of the year. It repaid at 104, and we have put the money to work elsewhere in various sectors. Barclays Bank, yeah, that's again self-explanatory. Azerion Group is a Northern European, basically Scandinavia and Germany, gaming designer business that currently is in the portfolio for about another 2 or 3 weeks. It's about to be called because it is being refinanced at a much lower rate than we currently have in that one, and we expect that to we will not be replacing it, because I think it's coming at a yield less than 8%, which is too low for us. Again, this just gives you a rough feel for where the premium and stroke discounts have been. You'll see a few spikes, and they by and large match up to various market panics at the time, and then again we will shortly go back to trading at a sensible premium. I think this is due both to the fact that investors are by and large very loyal to us, and hopefully we are as loyal to them by performing in line with their expectations. But obviously occasionally you will get glitches in the market where a fund manager, which certainly happened in August 23, they changed the fund manager, and the new fund manager no longer wished to hold our portfolio, and they just went into the market and sold it over a period of 3 or 4 days, trashing the price. But dare I say it, for some investors that was a great opportunity. Sector themes, well, I think I've probably covered this, but financials is our number one sector, again for reasons already explained. Diversity, at the top there you've got frontline shipping, which probably won't jump to many people as an obvious sort of investment for a yield fund, but it pays out 85% of its profits in dividend, and it is also a leader in green technology in the various tanker sectors, be it the VLCCs, Suezmax, Aframax, the guys that ship large amounts of oil around the globe, and that actually has been a very, very good performer post June, with all of the sort of geopolitics previously mentioned, and also with Trump forcing India not to use quite so much of the Russian oil, which is used by the dark fleet. It is showing the shortage of quality shipping to move vast amounts of crude oil around the thing, and we are now seeing day rates up at I think yesterday $90,000 a day for a VLCC, and the break even is about 33,000 currently for frontline. So that gives you a sort of feel for that. Obviously we've got energy transition there. Yes, Mangrove Lucto, European heat pump manufacturer, that's self-explanatory. REA, Palmer, we still hold the preference shares there. It's a very, very ESG run business. Also, it does have large areas of natural forest left for the environmental benefits, which is good. And also, obviously, at the bottom there, we do have exposure to the sort of solar sector and wind farms through people like Next Energy. It's an area where the only way we're going to get exposure is via equities in these companies, which are giving us high yields of around 11%, and it is trading on about a 32% discount to NAV currently. So it allows us to invest in a high yield there, where there are no bonds for us to play in. Right, well, the appendices are something that he's got all of our records on the team. But at that point, I'd actually hand back to probably Caroline to say thank you very much indeed for listening to me, and I'm here for questions.
Thank you very much indeed for that. Perhaps I'm hoping that Craig, our investment director, is online and he can help with moderating the questions that have come on.
Yes, of course. Thank you, Franco. Thank you, Caroline. We've had a few interesting questions from attendees today. First one, let's keep on the portfolio theme, Franco. How do you balance keeping the overall short duration of the portfolio with some very kind of juicy yields in the longer dated paper? How do you kind of keep that balance? How do you manage that and look for opportunities there?
Well, fortunately, over the years, the trend in issuance of the high yield market has come a lot shorter. When I first started doing fixed income many years ago, long duration debt was the norm. Convertibles came with 25-year lives, but now high yield by and large is a 5-year piece of paper. It is usually callable after 2.5 to 3 years, so this does make my life a lot easier from that point of view.
Thank you. Have you ever? No, sorry, that's for the chair. So I'll come back to that in a second. Financial exposure, Franco. Do you look at Building Society's CCDS paper? Do you look at that? Have you looked at that? Maybe explain what it is to our listeners.
Yeah, I mean, the CCDS paper is by and large relatively low quality, but it is obviously far better than the underlying equity. But yes, we do. We are in West Brom, Building. The reason that they haven't been sort of covered today is they are small holdings. The issues are illiquid. They're usually held mostly by the people that took them at issue. And it's very difficult to build up a position. The two building societies we're exposed to in the smaller end are people like Newcastle and I say West Brom. We are able to put these positions in, and hopefully we add to them over time, but not an easy thing to invest in.
Okay, thank you, Franco. A couple of questions on individual securities. You may have to be careful how you answer these because we have to kind of obviously not give too much of a view. But you hold Next Energy Solar Fund. Why did you buy that? Where do you think it's going is the question, and also a view on Next Energy as well. Right.
Let's put this Next Energy Solar Fund. As I mentioned, one, it, as I say, allows us to invest in a sector where we can't get the yields in debt. Two, when we purchased this, it was and it is currently on a discount of around 30%. When you've got a yield that is, a dividend that is covered, and it's currently looking like near a 13%. I think it is something that you would put into part of the portfolio.
Okay, thank you, Franco. Perhaps Caroline, we can ask you a couple of questions. You comment on succession and transition in the annual report. Can you give more detail on that? Has there been any consideration to introducing an assistant to Franco? Does anybody else know as much as he does, basically, within CQS?
Thank you. Yes, I mean, we are incredibly lucky to have Franco as our investment manager, as he's one of the most knowledgeable people about the high yield market, probably that there is. But nevertheless, we are deeply conscious of succession planning and transitions. And one thing that I will share is that every year in February, the board actually makes a visit to CQS's offices in London to do a number of due diligence things. And one of them is to meet and learn about the team backing Franco, so that we as a board are comfortable that there is support across all the required aspects, elements of running this portfolio. Yes, we are introducing a very senior portfolio manager from CQS to shadow Franco. And don't forget that the purchases that Franco makes have come through the whole CQS process. So he's not a one-man band at the moment anyway. And we have introduced Darren Toner, who is a very senior member, head of high yield at Manulife CQS, so that he works alongside Franco in the coming years, so that we're comfortable with the succession planning there.
And obviously, you haven't made any kind of formal announcement on that, Caroline. So that's just we're working with Darren at the moment. In due course, there'll be something more formal to the market. Is that the plan?
Absolutely. Perhaps I shouldn't have used the phrase assistant portfolio manager at the moment. It's just we know he's there. We know he's familiar with the portfolio. He's shadowing what's going on. He joins our board meetings from time to time, whether that's on Zoom or personally. So we're as a board, we're comfortable with this succession planning.
Okay, that's great. Thank you for that. Have you ever thought about hedging? We've got about 30% in non-sterling investments. Do you hedge that exposure? And if so, why? And if not, why?
Franco, do you want to take that, or shall I?
I certainly take this one.
Okay.
Yeah, I won't say my classic phrase, but hedging is very dangerous for portfolio managers, and has been proved so in the past. When I was the other side of the fence, I saw quite a few funds get carried very, very poor performance because they were hedging currency exposure in volatile times, which can go against you as well as for you. The answer being, if I like a currency, I will be invested in the bonds. If I do not like that currency, I will not invest in companies with that currency in their bond portfolio. Obviously, if you go back to sort of 2013 to 2015, this portfolio was probably only just over 50% in sterling, with the other exposure being to the Australian dollar, Canadian dollar, US dollar, and the Scandinavian currencies. And obviously, that helped us perform against a very weak time of sterling, and we then moved back to being around 70% sterling, which is basically around about the default position, because as I mentioned previously, if you think so the US is in growth, we're not. The dollar is, okay, they're cutting rates, which people will say, well, actually, will that not weaken the dollar? Yes, it might do, but when we realise how bad our economy is, sterling will weaken, and that is my reason behind it. But if you look at, say, the performance, the positive has come from being long some of the euro. The negative is the dollar. So in many ways, you're hedging by the percentage of risk you're exposing yourself to.
Thank you, Franco. Final one, another one for you, Franco. I know, and perhaps the chair. The high yield sector would normally yield 5.5 to say 6.5, 7, maybe really, but you're out there yielding nearly 9. Why aren't other people doing that? What makes it?
Well,
what makes it work?
Obviously, the closed-end structure is great for us and other people as well. fortunately, us, I have a network, and so the guys here in the financials and the high yield sectors have a network of brokers that show us lines or new issues which may be too small if you're a very large fund management house to have an exposure to. Something like REA would have been an example for that. Things like the Newcastle Building Society. These are issues where if you're one of the bulge bracket investors, you can't take a small issue like that. You need a certain size, and if you're running billions, a 5 million unit is neither here nor there. Whereas if you've got a fund that is the gross value is 350 million, then 5 million does make sense.
Yeah, I mean, I think the whole private placement piece you do, Franco, you have to be commended for. That's when I go out and talk to shareholders. That's the kind of secret sauce. People will phone up Franco and say, "We're doing a £200 million bond. It's not rated. It's not, and basically, it's like, because of that non-rating part, most people won't touch it either, Franco, which is important to say."
Well, this is true, but I mean, obviously, with our credit analyst in house, they will look at it, and if you like, they assign a theoretical credit rating to it.
And because of that non-credit rating, and it's a very small issue, these companies will pay, even though they're very solid, they're very very good companies, they will have to pay up for that borrowing. They'll pay 800, 900 in points of interest rather than 600 or 700, and that makes a big difference to how you fund the fund.
Certainly does. Thank you.
Couple more, one for the board and perhaps for Franco. Skin in the game, it's a good fund. Do you have any shares in it? You did mention that earlier on, Caroline. Do you want to say anything about that, both of you?
Yeah, Caroline, I'll get my way out first. It's only just me. Currently, I have 747,000 shares. That will be going up at the end of the month when my ISA money goes into nearer 750,000. But at the end of the day, I'm the demographic that needs to invest in this company for my sort of latter years. And from the board's point of view, do you?
I'm a fairly major shareholder. I confess to not being quite as much skin in the game as Franco, but I'm a fairly major shareholder. I've even bought some for my mother's ISA. She's definitely of a demographic that needs income. All the board members currently have some shares of varying sizes, so we are committed to the company.
Thank you. Kind of just almost there now, but on dividend cover, we almost made the cover this year. Do you have a formal target on cover, or how does that work?
Well, sorry, Frank. I'll answer that one, and then you can jump in. I mean, we are very conscious that the dividend paid by this company is extremely important to our shareholders. Whenever we talk to shareholders, they cite that as something that's very valuable to them. So the board is super focused on dividends and paying dividends. We have built up healthy reserves over the years. So we do have a little bit of a buffer that we did, as I mentioned before. We used a little bit this previous financial year just to make sure we covered the dividend. We don't have a formal policy. I think you can expect that our policy in the coming immediate years will be very similar to that which we've seen in the past few years. And I don't think that we will commit to something specific, but you can be absolutely assured that it is an incredibly important topic for the board to debate and to work out the right balance between all the competing issues when we decide what dividends we're paying.
Thank you.
Yep. Nothing to add from me on that one. Spot on.
And I think a final question for both of you: what's the biggest risk? What could make it all go horribly wrong? Kind of, how do you manage that?
Well, I think the biggest risk would be another GFC, rampant inflation. But then again, I think you'll find that if that's the case, there'll be a lot of other funds that will be doing an awful lot worse than this.
Caroline, what worries you?
Well, clearly there are market risks. There are, and I mentioned that credit risk is probably one of our biggest investment risks. And Franco's right. If we have a massive meltdown, then clearly we're going to be impacted. But so's everybody. I think one of the real strengths of investing in this, what would otherwise be a relatively high risk asset class, is the diversification benefits of holding 60 bonds or whatever, however many the number is at the moment, and some equities as well. So in the context of normal market conditions, I hate to say this, but I'm reasonably comfortable with where we are.
Okay. I think, that's useful. Thank you, both of you. The biggest risk I have, kind of keeping an eye on the overall strategy of the company, is probably, somebody coming along and dumping the shares again and kind of making anything go to a discount. I think our broker works hard at that. The company is very heavily focused towards retail shareholders now. So we don't have as many of those institutions, because institutions don't like buying things at premiums. They think they can do a better job, frankly. So we carry on as we do, basically, and monitor the share price every day. We keep a very close eye on it. So I think, there's always that risk. Somebody will come along and say, I've got 10 million shares, I want to sell them tomorrow. But honestly, nobody really wants to do that, because that would just depress the share price. That's just silly. So, our broker has a good network, and we talk to all our shareholders a lot, basically. So we do these webinars, we do some institutional work with our brokers, seeing some of our bigger holders. But as I said, there's not that many of them left now. It's mainly retail holders on the share register. Yeah,
I'll just add to that. Literally the institution stake is very, very small now. It was a case of, I did a lot of work into finding out who sold it and why. So change of fund manager, just get rid of it. And they didn't particularly, worry about, the price, because it was part of a much, much bigger investment. So, I still have, one or two income-related institutional shareholders on the list. I actually saw one yesterday, but they're not big holders now. I think the holder yesterday has probably got circa 5 million shares, which, in relation to a market cap of sort of 320 million share pounds.
650 million shares out there.
Yeah, 650 million shares. It's not a big percentage anymore, but certainly the daily volumes are led by and large by retail, and again, from being 75% institutional when I took it over, I think it's probably that now in retail. Craig, I think you can confirm that.
Yeah, that's correct. Yes. Well, thank you. I think we've answered all the questions that have come in. So I'd like to thank you both for your time today, and maybe hand back to Caroline for some closing words.
Yeah, well, thanks from me as well, actually, and particularly to our shareholders for your support of the company. And if you don't own any shares yet, well, perhaps we have encouraged you to change that. A final note, our AGM is on the 4th of December in Jersey, and we will be doing another of these Investor Meet updates nearer the time, so watch out for that. So thank you very much again, and goodbye for now.
Thank you.
Perfect, guys. That's great. And thank you all for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CQS New City High Yield Fund Limited, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.